Ladies and gentlemen, good day and welcome to Cantabil Retail India Limited Q4 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this call is being recorded. Before we begin, a brief disclaimer. The presentation which Cantabil Retail India Limited has uploaded on the stock exchange and the website, including the discussion during the call contains or may contain certain forward-looking statements concerning Cantabil Retail India Limited business, prospects and profitability, which are subject to several risks and uncertainties, and the actual result could materially differ from those in such forward-looking statements. I now hand the conference over to Mr. Vijay Bansal, CMD of Cantabil Retail India Limited. Thank you, and over to you, sir.
Good evening, everyone. On behalf of Cantabil Retail India Limited, I welcome everyone to the Q4 and FY24 earnings conference call of the company. Joining me on this call is Mr. Deepak Bansal, Whole-Time Director, Mr. Basant Goel, Whole-Time Director, Mr. Surinder Nigam, CFO, Mrs. Poonam Chauhan, Company Secretary, and Martin Capital, our Investor Relations Advisor. I hope everyone had an opportunity to look at our results. The presentation and results release have been uploaded on the stock exchange and our company website. Cantabil delivered another quarter of good performance despite challenging environment and considerable slowdown in consumer spending. We have shown notable performance by delivering a revenue growth of 12% in FY24 and will continue to manage business dynamically, ensuring long-term growth and sustainability. We have further strengthened our balance sheet by raising rupees 50.4 crore from foreign investors in Q4 FY24, which will help us to capitalize further on the growth opportunities. On the expansion front, we remain focused on pursuing our long-term strategic agenda by further expanding our reach and open 86 stores during the year. We are also good acceptability of our product through online channels. The revenue from online channels we have more than doubled in FY24 and is likely to further improve going forward. I now hand over the call to Mr. Surinder Nigam for giving update on the financial performance for the quarter. Thank you.
Thank you, sir, and a very warm welcome to everyone. Coming to the financials, standalone performance highlights for Q4 FY24. Revenue from operations for Q4 FY24 grew by 12% to 194 crore as compared to 174 crore in Q4 FY23. Coming to EBITDA for Q4 FY24, which stood at 43.9 crore as compared to 42 crore in Q4 FY23. EBITDA margin for Q4 FY24 stood at 22.6%. PAT margin for Q4 FY24 stood at 18.3 crore as compared to 16.9 crore in Q4 FY23. PAT margin for Q4 stand at 9.5%. Now coming to the financial year 24 highlights, revenue from operation for FY24 grew by 12% to 616 crore as compared to 553 crore in FY23. EBITDA margin for FY24 stood at 163 crore as compared to 165 crore in FY23. EBITDA margin stands for FY24 stood at 26.4%. Coming to the PAT margin for FY24 stood at 62.2 crore as compared to 67.2 crore in FY23. PAT margin for FY24 stood at 10.1%. Coming to our stringent policies, we have made an one-time inventory adjustment by 2.64 crore, which slightly impacted our EBITDA as well. So now we may begin the question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and one on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and two. Participants are requested to use handsets while asking the question. Ladies and gentlemen, we will wait for the moment while the question queue assembles. The first question is from the line of Resham Mehta from Green Age Wealth. Please go ahead.
Yeah, hi, this is Resha. Thanks for the opportunity. So my first question is on the demand. I think in your press release you have mentioned that demand has started improving April onwards. So can you just elaborate on that? And if you could quantify and give some color on rural versus urban demand, how is that shaping up April onwards?
Hi, this is Deepak Bansal. The demand was really well in the month of April, and the March has also shown very good demand. So we are really hopeful that this quarter one we will be able to deliver good same-store sales growth. And because it is visible from the last few months that demand has picked up well.
Okay, so can you quantify this? Is it possible? Like, let's say we have moved to a positive SSSG.
So since quarter is running, so April was on positive, we cannot give the clear number right now for the Q1. But in the month of March, the overall demand in terms of same-store sales growth was there. However, January and February was on a negative side. So putting together, March was in a plus growth and April as well. So that is how the sign for the future is being shown.
Okay, so qualitatively, if you can just comment on the demand bit, like were your COCO stores performing better than FOFO, or let's say your metro stores were performing versus your tier 2, tier 3 stores. Any color on that one?
The pattern is almost the same everywhere. Like initially when there was a recession started, when there was muted demand in the last year in the month of April, there was some pattern that tier 3 were slowing down and tier 1 was doing well. But when the year starts coming to an end, now the pattern is almost same. Demand is picking up everywhere. And it's whether it's franchisee store or company store or whether it's tier 1, tier 2, tier 3. So pattern is same now.
So it's picking up everywhere now, you're saying?
Yeah.
Right. And how much of our demand is linked to the wedding season?
Yes, April was a wedding season, so there was a definitely demand of the wedding wear products also, which also led to a spurt in the demand. And but wedding season is again there in the end of the June. So we are again hoping that wedding wear demand will come up again in the end of June.
Right. So if I were to just go a little bit further, so let's see how much of our annual revenue is dependent on the wedding season panning out well.
We sell a lot of suits and blazer category. So our suit and blazer category picks up well when there is a wedding season. So when there will be a good wedding season, our demand for the suit and blazer category will go up. So yes, it will contribute very good sales mainly in the month of winters, because mostly in the winter customer to buy these suits and the blazers. So we really hope that this year wedding season will be great.
And if we look at the annual numbers, so what percentage of revenue comes from these suits and blazers category?
I think it's something around 10%, specifically from this particular category.
Got it. And I have more questions. Can I continue or should I join back the queue?
Okay, you can continue.
Sure. So the other thing I wanted to understand was the seasonality part. If I look at your Q4 gross margins, they generally tended to be in the 50% range, while for the full year, it's been around 56% kind of gross margin. So what is the difference in the product mix, if you could talk about, which is leading to this margin differential, lower margins in Q4 specifically?
Yeah, the Q4 is majorly about selling of the winter products because January and February is a hardcore winter wear month. So it is again the end of season sale period of winter wear products. So that's why the gross margin goes less in the Q4 because winter our sales tend to grow, and that time end of season sale discounting is more. So this is the quarter when there is a maximum discounting happens due to winter wear products. That's why gross margin is less.
Got it. And historically, if we see, our gross margins till FY21 were around 50%, but then FY22 onwards, till date, if we see, they've been at around 55%. So there's been a bump up of around 500 bits on the gross margin front. So what has changed structurally over the last 3 odd years?
It is mainly due to the markup. We have increased our markup of the clothes. That's why the gross margin has increased.
Okay. And typically, what is the annual price hike, markup on clothes that we take? Generally, on an average, I understand that last 2-3 years were years of hyperinflation. But on a normalized basis, what would the markup be on an annual basis?
So there is a calculation criteria what we have been adopting. So basically, we earlier commentary also we have been mentioned. So if we procure the raw material costly, then it has been passed up. So we did not intentionally increase every season. Last year we did not increase our any kind of multiple otherwise. That is why our same store growth is affected as well. So we do not do intentionally, but considering the inflation, few markups we are doing year on year basis. Last year we did not do, but that is being happening.
But otherwise, on a steady state basis, we are confident of maintaining at least 55% gross margins going ahead as well?
Yeah, absolutely. If you see, just you have mentioned earlier, there are a lot of things, including the markup. When the company was in the establishment phase, we did not increase the markup, but we have taken a cautious call and correcting the around 3-4 years back, and then we have a commitment of maintaining 55% of the gross margin, which we are doing continuously. Last year it was 54.6. Last year we maintained it to 56.2. This year also we maintained 56% margin. Gross margin.
Got it. And on the press release also mentioned.
I'm sorry to interrupt, ma'am. Can you just follow back the queue, please?
Sure.
Yeah, thanks.
Thank you. The next question is from the line of Ankit from Shubham Ventures. Please go ahead.
Yeah, good evening, sir. A few questions from my side. Sir, first of all, in FY24, which is last year, the performance has not been that great. I mean, we had a negative SSSG, margins also declined. So, first of all, I would like to know how much of it would you like to blame on the macro part, and how much you feel there were some internal issues wherein this year you would focus on improvements?
Yeah, I would like to mention that during the first 3 quarters, there was majorly due to the macro part, there was a muted demand visible in the market. But in the Q4, the same store sales growth was negative because we controlled our discounts. So last year there was some higher inventory, give some more discounts. So this year, if you will check, our gross margin has increased in the Q4. So we have controlled the discounts, so there is a little downside in the same store sale growth in the Q4 numbers. But that was only there in the month of January and February. But in March there was a very good same store sale growth, and same has come in the April month also. So it was a combination of both macro factors and the internal area factors. So that I also mentioned that it was there in Q4 first 3 quarters, and in last quarter, it was our complete decision only.
So what was the exit rate of SSSG in the March month?
Quantity, it is 9%.
Okay.
In the month of March, yeah. SSG.
Okay. So my second question is that in the last couple of years, say in FY22-23, your EBITDA margins were in the range of 29-30%, which has declined to some 26%. So what kind of SSSG is required, to achieve this number again, the margins?
So same thing. We are focusing on getting the SSG year-on-year basis. Last year of -4%. There are a couple of reasons as we just explained. And 6 to 7%. We are focusing on 6 to 7% and considering the fact of the trend of March and April. So 6 to 7% SSG we are focusing to achieve those, coming back to that EBITDA margin of 28 to 30% range.
And what will be the main driver of this SSSG, say in the coming years?
Yes, there are a number of factors, number of things we are putting in place. First is the incentivization program. Up till now, we used to have like incentive only on the store sales for the front-end staff. But now some additional incentive programs have been introduced. Like earlier, everyone used to have a store incentive. Now there is an incentive for every staff at the store level. First thing. The second, there is like competition, for creating the healthy competition, we have created the incentivization program. Third is like we have introduced a category of the month category where again incentive program has been introduced in a particular category to boost the sales. So this is what about the incentivization to increase the sales. And fourth one is we have included the product category also. Many new kind of products have been introduced, like which were not there earlier, like cargos we introduced, flexible shirts we introduced, some flexible t-shirts we have introduced, and some bold and bigger prints have been introduced in the club wear category. So this was about the product improvement. Then there is some geographical special manufacturing for geographical areas also now, like for the west and the east, where winter wear is not happening much. So we are creating special category for the winter months for the western and the eastern region. So by combining all these factors, we are hoping to achieve around 7% SSG in the coming year.
Okay, and lastly, you have raised money through equity. So should we expect a very high acceleration in store expansion, or you feel this money would be used in working capital, or where do you see the utilization of this money, and resultantly what kind of growth and you are looking at in this year?
So the same thing. This money has been specifically there for the utilization of working capital, which will strengthen our margins in terms of gross margin. So that would be there. This is not the part of our capex expansion. Because of money, we are not overrunning in our expansion. That is the same ideology we are running at 6 to 7 store, 80 to 90 store year-on-year basis on a long-term sustainable basis. So that money is for working capital that we are utilizing for strengthening our gross margin. Capex part is internal and that is separate.
Okay. Thank you so much, sir.
Thanks, Sanjay. Thank you.
Thank you. The next question is from the line of Jatin Chawla from RTL Investments. Please go ahead.
Yeah, hi, good evening, and thanks for the opportunity. First of all, congratulations on maintaining strong gross margins even in a very weak demand environment. My question is on the store addition side. I see out of these 86 stores that you've added, only 2 have come from the franchisee route. The rest have come, where the company has itself added the stores. I think your guidance was for 1/3 will be franchisees and 2/3 will come from the company. So what is the reason? Are we not finding enough good franchisees to partners to open these stores, or what is the reason for a change in strategy?
Yeah, like earlier we used to have 30% franchisee stores and 70% company stores. Now the ratio is like 75% company owned and 25% are franchisee owned. This is mainly due to some deliberate calls also, because we have figured out that franchisee are not able to manage well. They were cutting the corners on the expenditure side, due to which sales were suffering. Second, some territories like Gujarat, Maharashtra, where the more stores were open. So this territory doesn't have like the franchisee stores. 99% stores in the Gujarat and Maharashtra region are the company stores. And we used to have more of the franchisee in the Rajasthan region, where 75% stores are the franchisee stores. But as the Rajasthan is nearing the saturation, so franchisees naturally have gone less in the company. So that's basically 2 factors due to which franchisee have gone less.
So going forward also in this 85 to 90 stores, 80 to 90 stores that you plan to add every year, most of them will be company-owned?
Yeah, most of them will be company-owned.
So similar, like 90-95% will be company-owned, very few franchisees, or will it change?
See, it's very difficult to literally comment it will be 85 or 95, but it is going to be like that only.
Understood. My second question was on your inventory days. I think finished goods inventory is at the same level as last year. Whereas last year we had a sudden demand slowdown in 4Q, and because of which we had higher inventory days. I think your commentary was that this time around March, the demand environment was slightly better. So why do we still have such a high finished goods inventory even this year?
So overall, last year, if you say my overall inventory level was 144 days, which has been down to 136 days now. My FG inventory, because that we did not increase in much FG inventory. Last year, my total inventory was 218 crore, which has been ended up with 230, even after we opened 86 new stores. So we managed in those inventory as well. So the conversion of raw material and WIP more in the finished goods, which has been consumed. So overall, earlier we also mentioned my inventory cycle would be approximately finished would be in this range only, 110 to 115 days. And overall inventory cycle would be approximately 130 to 135, what we have been regularly monitoring and controlling.
So going forward, we should expect this similar numbers to continue, or are you planning to lower your inventory further?
We are increasing range, as we say, we are continuously increasing range in terms of our accessories, in terms of ladies, kids, footwear has been launched, athleisure wear has been launched. So minimum MBQ is being there because my top line, whenever I increase my inventory, when I put 1 lakh rupees of inventory, that will add up to my revenue. So there's no point, just for a theoretical number, we are down. So 110 to 115 in terms of FG, and overall approximately 130 to 35 is an ideal number which we are going to maintain.
Understood. And on SSG, when you said 7%, 6 to 7% that you are targeting, are you assuming any price hikes, or this is entirely going to be volume led?
50-50. And we also meant 50-50 number, plus minus 1 or 1.5% is different. 50-40 we are into volume is to be increased in a proportion, as well as some hike would be there.
And just one last clarification. This one-time inventory charge of 2.64 crores, this is only in 4Q, or this is for the full year?
So whatever my aging inventory was there, however, it is realizable, much more realizable than it, but we have taken cautious call and bring it down to some level.
So my question was, this is charged only in 4Q results, or this was there in earlier quarters also?
Q4 results.
Q4. Okay, great. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Palash Kavle from Nuvama Wealth. Please go ahead.
Am I audible?
Yes, you're audible.
Yeah, thank you. Sir, thank you for the opportunity, sir. So my question is on segmental contribution. Our segmental contribution from men's category has come down from 86% to 83%. And even in terms of store openings, we have opened a lot of ladies and kids focused stores. So are you anticipating this trend to continue going on? And in terms of store opening distribution, how should we see going forward?
Yeah, like last year we opened 20 ladies and kids store, family store 20, men's and ladies store again 19, and men's store 34. So in total it comes to be around 98 stores. So same kind of pattern we plan to continue in the coming year.
Okay. So my next question is on the you mentioned in last con call that you are opening a larger size store. So what kind of store economics you get there? Payback, how is the payback period, and how are the revenue per square feet, revenue per store?
So like we have opened around 20 family stores last year. Average size of the store we opened last year is around 1600 square feet. So these stores haven't got the full year of the working. So it's difficult to comment early, because once these stores complete 1 full year, then we will be able to get you the full statistics about the store.
Okay. Sir, my last question is on footwear. So any comment on that? How would be the growth? What kind of growth would we be looking going forward?
Yeah, in the last year we have done footwear sale of 2.6 crores, and in the next year we are targeting footwear sales of 10 crores.
Okay, sir. That's it from my side. Thank you for your responses.
Thank you.
Thank you. The next question is from the line of Shirin Jana Mittal from Ratnatraya Capital. Please go ahead.
Hi, thank you for the opportunity. Just two questions. So one is on the earlier comment that you made about same store sales, like in terms of FOFO stores performing a little bit on the lower side and cutting corners. So can you just provide a bit of a breakup between what is your same store sales growth like in the FOFO stores and what has it been like in the COCO stores?
Same store sales growth is almost the same in both the categories, but we have faced some operational issues in the franchisee stores. So due to the operational issues, there are some last year around 12 stores were closed, so around 8 stores were the franchisee stores which were closed. So that's how we decided to better go more with the company-owned stores than the franchisee stores.
Okay, understood. And the second question was on if you can help me understand a little bit on the inventory aging side. So currently, what portion of the inventory would be greater than 12 months and greater than 9 months? And if you can just provide some color on that.
So out of my total inventory, approximately my 73% is less than a year, and 2 to 3 months inventory is approximately 15-18%, and more than 2 years inventory is all put together is approximately 7%. So that is a clear bifurcation, out of which we have made a provision of this 2.64 crore what I told.
Yes.
That's the number which we have.
Yes, that is very clear. Thank you. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rohit Jain from Anand Rathi Wealth Limited. Please go ahead.
Good evening, sir. Thank you for the opportunity. Am I audible?
Yeah, please.
So you mentioned in the presentation that our online sales have doubled. So have we been profitable through this in the e-commerce segment?
So yes, my online sale has actually 2.5x. Last year we did it to 13 crore. This year we end up with 33 crore. So as far as online is concerned, the profitability, yes, we are not on a negative side. We are not on a negative side because we have been maintaining the important is gross margin. Overall 56% margin, but 49% approximately margin we have been maintained here. So we are on a positive side on the bottom line, putting all the commission and advertisement and other expenses. Not very high as far as offline is concerned as compared to offline concerned, but overall P&L for my e-commerce is also on a slightly positive side.
It's majorly about clearing the leftover inventory. So much profit margin is also not expected from the online sales because we are only clearing the old season merchandising through the online sales.
Yes, sir. And what are we targeting or what are we seeing the share in current FY25 from what are we targeting from online sales?
This year we are targeting the net sales of around 50 crores, so which will be something around 6 to 7% of the overall company sales.
Overall, yeah. And so my second question would be, how much are we spending on marketing and advertising currently? And what would be the target in FY25?
Yeah, overall from a company perspective, this year we end up approximately 1.65%. And the overall target earlier we communicated is approximately 2%, so that would be in this range only. This year we end up with 1.62%.
Okay. And so one last question. So our capital work in progress has increased by 23 crores. So could you please throw some light on what has been this increase related to?
Right. So as we mentioned earlier, we are making new warehousing come office space as well as my existing Badurgarh capacity is increasing. So out of this 23 crore, that 18 CR would be there for my new office and the balance 9 crore has been there for my increase in capacity of existing Badurgarh factory, which both are expected to complete this year. Badurgarh, my capacity that would be started in this month itself, and new office warehousing facility would be by the end of this financial year. So this CWIP increase on the on account of mainly two, that is my new warehouse promotion space as well as increasing Badugar capacity.
Okay. Thank you, sir. That's all from my side.
Thank you.
Thank you. The next question is from the line of Rajesh Jain from Jinanand Research. Please go ahead.
Yeah, so thank you for the opportunity. I have a couple of questions for you. First, what would be the inventory provisioning policy going forward, considering we had to take some additional provisioning? And my second question is, does the online sales and return will also warrant increased provisioning going forward?
So two questions you asked, our inventory provisioning policy as well as online. So for
online sales and return, yeah.
Yeah, correct. So as far as inventory provisioning policy, this year we started taking a provisioning for our aged inventory, right? Okay. We are making it more stringent, and that would be in the coming financial year. Exact 50% we have made 5 crore out of 5.4 this year. Okay. We may review it again and more stringent policy would be there. As far as e-commerce is concerned, this year we will be able to deliver approximately 5.5% and target for coming financial is approximately 7%. And going forward to make it a 10%, 8 to 10% approximately when the 1,000 crore company would be there in terms of revenue.
Okay, sir. Thank you. Thank you very much.
Thank you, sir.
Thank you. The next question is from the line of Meet Rachi from Anubhuti Advisors. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is in terms of the store network. So right now we are mainly focused on West and North. So just wanted to understand the incremental stores which you are targeting, the 700 in FY26. So incremental 170 stores would be opened in which regions? I agree it will be opened in Tier 2 and Tier 3, but in which states?
Yeah, today we have the maximum presence in the north, around 50% stores are in northern India. Then western India is around 35% stores, and 15% stores are in the center and the east. And we have almost no presence in the south India. So most of the stores will be coming in the center and the eastern region. But yes, there is still a scope for expansion in the north and the west also. So we will be expanding in the north and west also. And after around 2 years, we will be going to the South India because most of the markets will come to close to saturation in the other parts of India after 2 years.
Okay. Understood. And second question is in terms of the FY26 guidance. So earlier you mentioned that we will have a target of 1,000 crore revenue in FY26. So do you still maintain that guidance or is it changed?
No, but broadly it is same. So by the 20% CAGR we have been planned. So not exactly by end of FY26, but mid of FY27 or FY27, we are definitely going to cross 1,000 crore revenue company. Yeah.
Mid of FY27.
Mid of FY27.
Okay. And last question is in terms of the discount schemes. So generally what happens is you start with lower discounts in Q1 and then it gradually increases. And in the fourth quarter, you have that buy to get 5 scheme. So do we still want to continue with those discount schemes or there's something changed in that?
We start the season with the buy 3 get 5 offer. So it basically amounts to be around 35% discount. And then we move to the 50% discount for a month. Then we move to the buy 2 get 5 period. So it happens in both the summer time and the winter time. So this pattern will continue. We plan to go by the same strategy and we don't plan to change our strategy.
Okay. So there will be a substantial bump in our EBITDA margins in Q1 as compared to Q4, right?
Yes, it goes earlier as well. So when my Q1 margin is always very high, it is even more than 65% Q1 margin. It's the same thing because that's the most least discounted period and then it is getting down quarter on quarter basis. However, sales is increasing on quarter on quarter.
Okay, understood. That's all from my side. Thank you so much.
Thank you, sir.
Thank you. The next question is from the line of Arpan Rathod from Insight Advisors. Please go ahead.
Good evening, sir. Just wanted to understand in the presentation in the focus area, you have mentioned that there is a focus to reduce cost and achieve efficiency. in order to remain competitive. Just wanted to understand what are the key steps which you guys have taken, and also how much in terms of percentage you guys are looking to save on this.
So you're mostly, the question is what are the parameters which we are going to improve efficiencies, right?
Correct. And the likely savings because of that.
Right, correct. So there are two things. There are two aspects of efficiency. Either you improve the top line or reduce cost. So Deepalji initially told you what are the steps we are taking to improve our sales. So that is also we are considering as a part of efficiency. As well as, if you've seen, we are increasing the capacity in our Madhugar plant. That will give us more efficiency in terms of production. So that would be heavy. So obviously overall cost some percentage reduce. So overall these efficiency and efforts to maintain our gross margin, which we are committed to maintain approximately 55%, 55 to 56%.
Okay. And do we see going forward, maybe a year down the line, this gross margin going to 56, 57%?
Yeah, that's the internal target is day one. For last year, we are continuously delivering 55%. It would be 56% last year, this year also. So 55% commitment in terms of gross margin is still there, and that would be continuous.
Okay. And last question from my side. How has been this season so far, April and May?
Yeah, April season has been quite good. So it was a wedding season also. There was good spurt in the demand in the April season compared to the last April. And we hope that we will close the first quarter with good SSG.
Great. All the best. Thank you.
Thank you.
Thank you. The next question is from the line of Rahul Gupta from Mong Investors Research Analyst. Please go ahead.
Hello. Thank you so much for this opportunity. Sir, I had a couple of quick questions. Firstly, what are we doing on the digital front in terms of sales? How are the revenues looking up, and what is the target of digital revenue in online sales in a way for FY25?
Yeah, our online sale contribution was around 5% last year, and this year we are targeting around 7%. So last year sale was around 32 CR from the online. This year we are targeting 50 crores from the online. And the digital marketing activities are always a part of the company, so it enhances the both online and the offline sales. So we are doing various kinds of activities to boost our sales, like influencer marketing, display ads, etc. So it is helping. Naturally, it will first so it helps in the online sales, but it's also helping in the offline sales also. So, but our total expenditure both for the conventional and digital marketing is 1.6%.
Okay, and could you tell us about the margins as well on these online sales?
Online has a lesser margin than the offline, like it's 8% less than what is there in the offline.
Okay, thank you.
Thank you. The next question is from the line of Adriel from Zinanand Research. Please go ahead.
Hi, good evening. Thank you for the opportunity. So recently you all issued a preferential of 50 crores. So I had a question relating, does the company plan to issue more such shares and dilute the equity further on?
There is no such plan as of now. There is no such plan. There is IR is a continuous part. So the investor having different choice also. So that is the preferential allotment. So there is no such plan of existing dilution of equity.
Okay. Thank you. Best of luck.
Thank you. Next question is from the line of Prajit Mehra, from an individual investor. Please go ahead.
Yeah, hi, thank you for the opportunity. So the FY23 report mentions about the 53% increase in remuneration for the directors compared to FY22. So I'd like to know if there's similar plans for say FY25 and whether such adjustments were made for FY24.
Sorry, your question is Come back. Can you please?
No. There's a 53% increase in remuneration for the directors in FY23. That's what mentioned in your report. So I'd like to know if such adjustments were made for FY24 as well, and if there are such plans for FY25.
There is no such plan. There is no such plan. There was an earlier slightly on the lower side which has been corrected to the market rate. There is no such plan too. There is a slight remuneration increase as a part of annual process. Nothing. There is no such.
No. So what about FY?
Sorry.
No. What about FY24? So FY23 there is a 53% increase as compared to FY20.
FY23 and FY24 was same.
Same. Okay. Thank you.
Yes.
Thank you. The next question is from the line of Resha Mehta from Green Age Wealth. Please go ahead.
Yeah, thanks for the follow-up. So just one quick clarification. So when you say that you don't need to dilute equity anytime soon, so at least can we assume that for the next 2 years until you reach a target of 700 stores, you will be able to meet the capex from your internal accrual?
Absolutely. For last year, whatever the capex and other investment has been done from the internal accrual only, and going forward, all the capex and expansion, even my Badugar capacity increase, new warehouse, all from the internal accruals only.
Right. And the other one on the women and kids wear. So clearly we're seeing an increasing focus for these two categories. And recent store openings, etc., in your presentation also show that there is a focus here. So how would a higher share going forward of women and kids wear change the unit economics of the store? So are they more higher margins, or if you can just elaborate on that one, that how would the unit economics of the store change, if at all?
Yeah, in the ladies and the kids category, the gross margin almost the same. So, and going further also, we believe we'll be going with the same gross margins.
All right. And okay. And on the competition front, if you could just comment on that, typically in, let's say, a tier 2 or a tier 3 town, in your catchment, which are the other men's brands that are generally available in and around our store?
Basically, there are three kind of brands. One is the large format stores, which are selling in the value for money category. So, second is the premium brands during the end of season sale, they come close to us. Third is the vanilla brands which sell very close to our price points. So basically there are three category of brands which are doing which we are having competition with.
Got it. Thank you and all the best.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Jatin Chawla from RTL Investments. Please go ahead.
Yeah, thanks for allowing the follow-up. So, did I hear right when you said that for 1Q you are hoping for a double-digit SSG?
No. Here we are looking for 7%. 7%. Single digit we are looking for that.
Okay. So 1Q, I think the base is very low, right? Last year 1Q you had like a minus 7% SSG. So this pickup that you're seeing in April, is it just on account of a low base, or are you actually seeing a improvement in sentiments on the ground?
Hey, overall, even in the month of March and April, there was not only double-digit growth, but on a higher side, that is plus 20. So we are subduing that, and from the this last to last year point of view, it is there. So overall, we are looking for the growth from current financial year only.
Got it. And this, you've opened store sizes. I think last year has been much bigger at about 1,600 square feet. So do your other store costs remain the same, or other store costs also go up? So should we then look at SSG, or should we look at how the revenue per square feet number is trending?
If I understood your question, what you are saying, this is what we are talking numbers are average numbers, right? Overall for the store. So this year 1,500 is the biggest store. That is slightly down on the side of per square feet sale. But at the same time, your per square feet cost is also getting down. So that is how it has been impacting.
And the per square feet cost is coming down because you are going into smaller towns where the rental costs are lower?
Yes, correct. You are right. Whenever you are negotiating better, larger store is being there, then the first floor is there, so you are getting slightly better rate as well as in the manpower, because there are two biggest costs. So on the same side, when the per square feet sale definitely affecting when you are opening the larger store, but there are some benefit on a per square feet basis. Theoretically, you are getting lower on a cost basis as well.
Okay. And this SSG number that you call out, what stores do you use? Do you use like stores opened 12 months before, 24 months before? What is the stores where you measure SSG?
Weighted average. If it is the 1 month, then it is a 1 month. So weighted average, apple to apple comparison is there for the last year.
Okay. No, when you say apple to, meaning, so let's say a store was opened in January this year. That should not be part of your SSG calculation now, right? Because that it's not there in the base.
That can't be part of the calculation because in last year it has no data because it wasn't open. So only the stores which used to have last year data, either partially or fully, can only be accommodated in the report.
Got it. Okay, thank you.
Thank you.
Thank you. So that was the last question for the day. I now hand the conference over to Mr. Deepak Bansal for closing comments. Over to you, sir.
I would like to thank you all for joining us on this call today. We hope we have been able to answer your queries. Please feel free to reach out to our CFO or IR team for any clarification or feedback. Thank you all.
Thank you. On behalf of Cantabil Retail India Limited, that concludes its conference. Thank you for joining us. You may now disconnect your lines. Thank you.
Thanks, sir.